You'd think that a bank doubling the amount of money it lends out in just 2 years would mean they're taking on some massive dangerous risks.
Right, like the historical precedent for that kind of hypergrowth in lending almost always ends with a spectacular crash.
Oh, absolutely. I mean, growth at that velocity usually forces a lender to scrape the bottom of the barrel for borrowers,
Right.
which inevitably destroys their asset quality.
But what if I told you there's a fintech platform that actually doubled its loan book and their default rates went down?
Oh, I mean, it sounds like a paradox, but when you look under the hood of what's actually happening here, it's not a paradox at all. It's basically a masterclass in structural data advantage.
And that is exactly the mission for our deep dive today. We're getting our hands on the Q1 2026 financial supplement from SoFi. And for you listening, we're going straight past the, standard glossy earnings presentation.
Yeah, those are just marketing, really. Exactly. The financial supplement is where the actual operational plumbing of the company is exposed. It shows the unit economics, the cohort data, the true cost of capital.
It's the real story.
Right. So our goal is to translate these dense metrics into the real narrative of how a company successfully transitioned from a single-lane student loan provider
Yeah.
into a comprehensive, highly profitable fintech powerhouse.
And it's a crucial transition to study, too, because, we've seen so many digital financial startups acquire massive user bases over the last decade, only to, well, fail completely at monetizing them.
They build great apps, but terrible businesses.
Exactly. Looking at these internal metrics shows exactly how you build a lasting economic engine.
Okay, let's unpack this, because to understand the financial health of any platform, you really have to look at its user foundation. And the data in this supplement is, well, it's aggressive. SoFi's total members jumped from 8.13 million in Q1 2024 to a projected 14.7 million in Q1 2026.
Which is massive.
Yeah, it's a sustainable year-over-year growth rate of about 35%. But here is the data point that actually caught my eye. While they have 14.7 million members, the total number of products those members are using is projected to cross 22 million.
Yeah, and that gap right there between the user count and the product count, that's the single most important leading indicator of their long-term profitability.
Because they're adopting more than one thing.
Right. The product count is outpacing the user count by a wide margin, which tells us their ecosystem is functioning exactly as designed.
It really makes me think of the ultimate consumer psychology trap, the Costco trip.
Oh, yeah, the classic.
You walk into the warehouse for one highly specific item, like maybe you just need to pick up a rotisserie chicken.
Yes, the chicken, yeah.
And for a SoFi customer, maybe they only downloaded the app because they needed to refinance a personal loan. That was their one immediate friction point.
Right. They have a discrete, single-use financial need.
Exactly. But then you start walking the aisles. You see the electronics, the bakery, the bulk coffee. And before you know it, you're at the checkout register and your cart is completely overflowing.
Yep.
In SoFi's case, a user comes in for that single loan, but they end up leaving with a checking account, a high-yield savings account, and like an automated investment portfolio.
What's fascinating here is the underlying margin expansion of that Costco effect. This is a highly orchestrated strategy of cross-selling, and it's entirely digital.
Which means no overhead.
Exactly. The marginal cost of adding those extra items to the user's card is essentially zero. And the supplement shows that financial services products, that's the checking, savings, and investment accounts, those are growing at 40.2% year over year in Q1 2026.
Wow.
They're heavily outpacing the legacy lending products.
So they're getting people into the ecosystem and successfully routing them into daily use products.
Yeah.
Why does that specifically dictate their survival against the, legacy brick and mortar banks?
Well, it comes down to customer acquisition cost, or CAC, versus lifetime value. In the traditional financial sector, customer acquisition is notoriously brutal and expensive.
Like paying for branch locations and TV ads.
Right. If a legacy bank spends hundreds of marketing dollars to acquire a user for a checking account and then has to spend another massive marketing budget to find a different user for a personal loan, their margins are structurally suppressed.
That makes sense.
But SoFi is acquiring a user once, paying that acquisition cost once, and then organically cross-selling them into a multi-product relationship right within the same app interface.
So they're monetizing the exact same user multiple times without having to bid against competitors on Google or Facebook ads for each new product.
Precisely. As the products per user ratio climbs, their blended customer acquisition cost just plummets. And just as importantly, it creates profound stickiness.
Stickiness.
Yeah, when your entire financial identity, your mortgage, your daily checking, your emergency fund, your stock portfolio is integrated under one digital roof, the friction required to leave for a competitor becomes enormously high.
Oh, nobody wants to deal with moving all of that.
Exactly. You're building an ecosystem that users simply do not want to untangle themselves from.
But wait, hold on. I'm looking at these lending originations, and they are exploding. They're jumping from $4.3 billion in Q1 2024 to a projected $12.1 billion in Q1 2026.
Yeah, that's a huge jump.
Right. So with all this talk about a diverse financial ecosystem, doesn't that massive $12 billion number mean they're actually just a traditional lender heavily disguised in tech company clothing? I mean, aren't they still completely dependent on originating debt?
If we connect this to the bigger picture, it's very easy to look at top-line originations and assume lending is the only operational lever that matters. And you're absolutely right that lending is growing rapidly across personal, student, and home loans.
So it is a huge part of the business.
It is. But to understand how the unit economics of the business have fundamentally transformed, we have to ignore top-line revenue for a moment. We need to focus strictly on contribution profit.
Right, because top-line revenue doesn't actually tell us what it costs them to generate those dollars.
Exactly. Contribution profit strips away all that noise.
Right.
It isolates the revenue of a specific segment, subtracts the direct variable costs of running that segment, and shows you exactly how much cash that division is actually kicking up to the corporate vault.
Okay.
And the data reveal here regarding the financial services segment is just a violent structural swing. Let's look at the timeline. In 2022, the financial services segment was operating at a $200 million loss.
Wow. It was just a massive cash burn.
Huge burn. But by Q1 2024, it reached an inflection point and posted a $37 million profit.
Okay, that's better.
And the projections for Q1 2026 show that segment hitting an incredible $195 million in contribution profit for a single quarter.
Wait, really? Going from a $200 million annual loss to nearly a $200 million quarterly profit in just a couple of years, that is a massive swing. What exactly flipped the switch on their unit economics to make that happen?
Economies of scale on a fixed-cost technology stack.
Break that down for us.
Back in 2022, they were absorbing the massive fixed costs of building their cloud banking infrastructure, acquiring a national bank charter, and setting up the compliance architecture.
Oh, so they were paying for the foundation.
Right. They were pouring money into the foundation. But once that foundation is built, the marginal cost of onboarding the next million users or opening the next 5 million savings accounts drops to almost zero.
Because the software is already written.
Exactly. The infrastructure is paid for. So now every cross-sold product you mentioned in that Costco analogy drops pure profit straight to the bottom line.
Oh, wow.
That is why the total 2025 financial services profit is projected to hit $790 million. The engine is finally humming at scale.
Okay, so the operational efficiency is locked in. But operating a fully fledged financial platform and actually acting as a chartered bank means stepping out of the insulated tech startup sandbox, right?
Oh, entirely.
You're stepping directly into the global macroeconomic weather system. And here's where it gets really interesting on the balance sheet. Looking at the Q1 2026 projections, there is $40.2 billion in customer deposits, sitting on a total asset base of $53.7 billion.
Yeah, and that deposit base fundamentally alters their position in the market.
It's a masterclass in capital efficiency. I mean, instead of having to go to the wholesale debt markets and pay a premium to borrow money from Wall Street just so they can lend it out, they're sourcing their inventory of cash directly from their own users' checking and savings accounts.
And that transition to direct deposit funding is the sole driver behind their net interest margin, or NI.
Right. And for you listening, think of net interest margin as a measure of a bank's supply chain economics. It's basically the spread between the yield they generate by selling money, so the interest charged on loans, and the cost to acquire that money, the interest paid out on deposits.
Exactly. It's the markup.
Yeah. And looking at the supplement, there's a fascinating dynamic playing out with their NIs. The data shows that SoFi's asset yields are actually projected to drop from 9.76% down to 8.58%.
Meaning the interest they're charging their borrowers is compressing slightly over this time frame.
Correct. But Their funding costs, the interest they have to pay out to secure that capital, are dropping significantly faster. Those costs are falling from 4.4% down to 3.10%.
Because they've scaled that massive $40.2 billion pool of direct customer deposits, they no longer have to rely on expensive external warehouse facilities. They control their own supply chain of capital.
Right.
And because their cost of funds is dropping faster than the yield they charge on assets, their overall net interest margin remains highly stable in the high 5% to low 6% range.
Which is huge.
It's crucial. It proves that even if macroeconomic interest rates begin to fall broadly across the board, SoFi can defend its high profitability through its deposit-based funding model. They're insulated.
But I have to bring up the elephant in the room regarding that $40 billion loan book.
Yeah.
If their loan assets are nearly doubling to $40.6 billion by Q1 2026, how do they maintain asset quality? I mean, you can't double a loan book that quickly without taking on massive uncalculated risks, right?
Right.
Are they just lowering their underwriting standards to fuel that growth?
Well, that is the first question any institutional investor would ask. But the internal data completely disproves that thesis. Despite doubling the size of the loan book, their 90-day delinquency rate on personal loans actually fell.
Wait, it fell?
Yes, it dropped from 0.72% in Q1 2024 down to 0.47% in Q1 2026.
Yeah.
And their student loan delinquency rate is practically non-existent. It's sitting at 0.1%.
So they pushed twice as much capital out the door, and the default rate actually shrank. How is that mechanically possible?
It comes back to the ecosystem advantage we discussed earlier. Look, legacy banks largely underwrite loans based on a static, backward-looking credit bureau report.
A credit score.
Right. But because SoFi is capturing the user's checking account, their direct deposits, and their daily spending habits, they have a real-time 360-degree view of the borrower's actual cash flow.
Oh, because they're the ones holding the bank account.
Exactly. Their algorithmic underwriting isn't just looking at a credit score, it's looking at a proprietary ledger of the user's financial health. This allows them to aggressively target high earners with pristine cash flow. It's what the industry calls NREs.
High earners, not rich yet.
Exactly. They aren't lowering standards to grow. Their data advantage is simply allowing them to safely identify and capture prime borrowers that legacy models might misprice or just miss entirely.
Okay, so the operational engine is humming, and the risk models are executing perfectly. But as an investor, or just someone analyzing the business, how do you actually verify that success on paper when corporate accounting can be so easily manipulated? We really have to look at how these results hit the final scorecard.
Yeah, you do.
Because the gap between standard GAAP accounting and adjusted metrics can be massive.
It can absolutely be a hall of mirrors. I mean, standard accounting rules are necessary, but they often force companies to recognize non-cash items that severely distort what is actually happening with the cash in the vault.
And there's a glaring anomaly staring at us in Q4 2024. Under official GAAP rules, SoFi's net income seemingly skyrocketed to $332 million for that single quarter.
It looked incredible on paper.
Right. If you just glanced at the headline, you'd assume their core business tripled overnight.
But that massive spike was an accounting illusion. It was not driven by operational cash flow. That $332 million GAAP figure included a $258 million one-time tax benefit.
$258 million.
Yeah. It's related to the release of a valuation allowance on deferred tax assets. Look, it is a necessary paper adjustment required by accountants, but it does not represent actual cash flowing in from customer operations.
Right, this is a technicality on the balance sheet.
Exactly. If you strip out that one-time tax quirk and look at their non-GAAP adjusted net income, it was a much more grounded $61 million.
Which is still a highly profitable quarter.
It is, but it's an accurate reflection of reality, and this raises an important question. If standard accounting rules can temporarily distort reality with massive paper gains, what specific metrics should we be looking at to measure true, sustainable cash generation?
We need to see the actual cash piling up.
Exactly. And the supplement highlights two critical metrics for this. First is cash revenue, which strips out all non-cash accounting adjustments to show pure top-line cash generation.
And what does that look like?
Their cash revenue is projected to jump 41% to $3.75 billion in 2025, and it's going to cross the $1 billion mark in Q1 2026 alone.
Over $1 billion in actual cash revenue in 3 months. That's real money.
It is. Second, you look at adjusted EBITDA. This strips out interest, taxes, and depreciation to reveal the pure cash profitability of their core daily operations.
Day-to-day business.
Right. And not only is the total dollar amount of their adjusted EBITDA growing massively, but the margins themselves are expanding from 25% up to 31%.
Meaning for every dollar they bring in, they're keeping a significantly larger slice of it as pure operational profit. The business is becoming structurally more efficient the larger it scales.
Exactly. So what does this all mean for the valuation of the firm? When you strip away the one-time tax benefits and the marketing narratives, how do you measure the ultimate unshakable floor of a financial company?
Right, the bedrock.
In the banking sector, the ultimate truth serum is tangible book value, or TBV.
Let's talk about TBV, because standard book value can often be inflated with a lot of invisible fluff, right? Like goodwill from past corporate acquisitions or the theoretical value of a brand name.
Right.
Things that sound great on a spreadsheet, but you can't actually liquidate to pay depositors in a crisis.
Precisely. Tangible book value strips all of those intangible assets away. It leaves only pure, hard assets, cash on hand, the actual loan portfolio, physical property.
Real stuff.
Right. It asks a very grim but necessary question. If we halted all operations today and liquidated the actual assets, what is the hard, unencumbered equity left over? And the growth here is staggering.
What are the numbers?
The data shows their tangible book value expanding from $4.1 billion in Q1 2024 to $9.2 billion in Q1 2026.
They're more than doubling the physical wealth of the company in just 24 months.
And here's why that matters for the individual shareholder. Often, a company's total equity goes up simply because they issued millions of new shares to raise capital.
Which dilutes the actual ownership stake of existing investors.
Right. But SoFi's tangible book value per share, the actual hard wealth assigned to a single share of stock, is rising from $3.90 to $7.21.
So even factoring in the growing number of shares, the overall pie is getting so massive that every individual slice is getting radically thicker.
Yes. Furthermore, their return on tangible common equity, or ROTCE, confirms how effectively they're deploying that wealth.
Because ROTCE measures how efficiently a bank uses its tangible equity to generate more profit.
Exactly. For SoFi, that metric flips from a negative 11.1% in 2022 to a positive 8% in 2025. This proves they aren't just hoarding capital, they are actively compounding it. It is the ultimate proof of a company building real structural wealth.
It's the architectural blueprint coming to life. So to recap the journey we've taken through these documents today for you listening, we have mapped out how SoFi evolved from a niche lending operation into a highly profitable, comprehensive financial ecosystem.
Yeah, it's a huge shift.
We've looked at the underlying mechanics of a projected $40.2 billion in direct customer deposits, a zero marginal cost cross-selling engine that crushes acquisition costs, and an algorithmic underwriting model that actually drives default rates down even as the loan book scales to $40 billion.
I mean, it is a definitive case study in how to leverage a digital tech stack to fundamentally alter the unit economics of traditional banking. And I want to leave you with one final structural thought to ponder on your own based on what we've unpacked today.
Let's hear it.
If a digital native platform can engineer this kind of rock-solid capital foundation, scaling up to tens of billions in deposits so efficiently without the massive crippling overhead of operating physical branch networks, all while utilizing proprietary ecosystem data to keep delinquency rates lower than the legacy institutions.
Yeah.
How long will it be before those century-old brick-and-mortar banks are forced to completely cannibalize and rewrite their own business models just to survive the structural cost disadvantage?
That is the ultimate existential question for the financial sector. When the new digital infrastructure proves it can scale cash more efficiently than the 100-year-old stone bank across the street, the entire landscape has to adapt. Thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking at the underlying blueprints, and we will catch you next time.